What is portfolio suicide and how can you prevent it? How does overconfidence hurt investors? And how does Warren Buffett believe most people should invest? We'll answer these questions and more on this, the 24th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody. Welcome to day 17 of the 31-day money challenge. We're just a little over halfway through the month of January. Yesterday, we looked at the importance of investing like a business owner. I hope you had a chance to listen to that podcast. If you didn't, you'll find it at DoughRoller.net/podcast 23. It probably gives you as good a glimpse as anything into at least my views of investing and how I approach investing, both in individual stocks and also in mutual funds. Today we have a guest on the show. Larry Swedroe is going to be on the show. He is a very well-known author, written a lot of great books on investing. He's going to give us his perspective. And also have a number, three questions and comments that I'm going to read from listeners that have emailed me recently. They kind of bring up different issues and topics, and I thought it'd be fun to cover a few of those as well. So that's what we're going to do today. Before we get to the main part of the show, let me first acknowledge our sponsors. Without our sponsors, the 31-Day Money Challenge really wouldn't have happened, and I'm grateful for their effort. The first is Betterment. Betterment's an online platform that invests your money for you. You can invest it in both stocks and bonds. All you do is pick the percentage you want of each, and Betterment does the rest. It invests your money in low-cost ETFs. It automatically rebalances your portfolio and reinvests your dividends. You can check them out at betterment.com. And one of my favorite investing tools, Personal Capital. It's free. You can sign up online. You can then link all of your investment accounts from the various brokers that you have, 401ks, IRAs, everything. It will track your performance for you. It'll compare your performance to an index if you'd like. It'll show you your asset allocation across all your investments as well as the fees that you're paying. It's an excellent tool. You can check them out at personalcapital.com. Okay, so let's tackle some reader questions first, and then we'll move into the interview with Larry. First up is a reader named Sheila, and I think her comment came from an article that I published on in my weekly U.S. News column about, I think it was entitled "Retirement or Cable TV? You Decide." And the basic idea of the article was that with relatively small amounts of money invested each month over a long period of time, you can accumulate a very sizable portfolio. I'll leave a link to that article in the show notes. But Sheila emailed me and she said, I gave up cable, ! I'd rather save the money. Watching TV is not living, as one of your readers said. Plus, it's a monopoly and we are being ripped off. I love the email. Sheila, congratulations. The key is saving it. When you reduce your monthly expenses, the key is to take that money and do smart things with it, not dumb things, right? It sounds like that's what Sheila's doing. One of the things I do is just immediately take that extra money from cutting out some bills and move it right over into my investment accounts. I don't let it sit in my checking account. If the longer it stays in my checking account, the greater the odds are I'll do something stupid with it. So that came from Sheila. And then another reader named Lee, and I think he was reading the same article, he had this to say, and by the way, in that article, I assumed an 8 or 9% return on investment. So Lee responded, he said, really interesting idea, but where is anyone making 8 or 9% a year? In recent memory, I was making 6% a year in a money market fund versus the hypothetical 7% historical average in the stock market. Now, my money market fund pays pennies a month. Although it's a great idea, I feel like it's irresponsible to suggest that people will achieve such a high rate of return. Well, I get into a lot of conversations with folks about how the stock market will perform over the next several decades. And my opinion is simple. I have no earthly idea how it's going to perform. However, when you're making planning decisions, it's helpful to make some kind of assumption when you're deciding how much you need to save, how much you can withdraw from your portfolio when you retire. Obviously, you need to be flexible and you need to be able to adapt as events unfold. But you have to make some kind of assumption oftentimes in planning. And I find 8% to be as good as any. Some estimate as low as 6%. I have no argument with that approach. I think when you get much above 8 or 9%, for me, it just is too unrealistic. I will say that the historical average of the stock market, at least let's say the S&P 500, isn't 7%. If you go back to, say, you take it all the way back to the 1920s and you bring it forward, it's more like a compound annual growth rate of about 10%. That being said, 8% is still hard to achieve because you've got to have, in my view, you're going to have to be heavily weighted towards stocks, probably in the 60 to 80% range. And then you need to stick to your plan. And as we discussed yesterday and with Carl Richards the day before that, the author of The Behavior Gap, sticking to an investment plan is not easy. But I don't personally think 8% is unreasonable. If you do, great. You may want to go with a lower number. I will say that it looks like Lee's got his money invested in money market funds, and certainly you will not achieve 8% in money market funds. So that's certainly true. I'm speaking more of a mix of stocks and bonds that are more weighted to stocks than bonds. Okay, our final comment comes from Paul, a reader named Paul. He says, I found the DoughRoller podcast on episode 3 and have listened to almost all of the episodes. I really appreciate the work you do and want to thank you for the podcast. Money was an issue for my family when I was growing up, but I remember the arguments my parents did have was around money. My girlfriend and I are starting to discuss marriage, and I want to make sure we are on the same page about being fiscally responsible. Can you provide any recommendations on how to manage your finances as a couple? You often mention about how you and your wife worked together to get out of debt. Do you have your own banking accounts and a joint or a joint bank account? Do you have a monthly portion of your paycheck go to your own account and a portion go into a joint account? I'm really looking for templates about what works for others. We both work and see paying off debt as a priority. The one thing in that email that really caught my eye was actually the very last question where he said, we both work and see paying off debt as a priority. With a significant other, you're not always going to see eye to eye on everything. At least that's been my experience, and I think my wife would probably agree with me. And you're not going to always see eye to eye on money as well. My wife and I certainly haven't. She was much better with money when we got married than I was. She likes to tell the story when I was in law school. When I was in law school, we lived in Boston, and it's tough to park in Boston. And she was in the car one day and opened up the glove box, and a bunch of unpaid parking tickets came flying out of the glove box. That was a long time ago, and she still really likes to tell that story. So we didn't always see eye to eye. But one thing Paul says is that they both see paying off debt as a priority. And so it sounds like they see eye to eye on that very important topic. And that's good news. In terms of sort of the money management, we've never had separate accounts. From the day we got married, we had a joint checking account, joint savings account. All of our taxable investment accounts are joint accounts. We've just never maintained separate bank accounts. I think for a lot of folks that are perhaps on their second marriage, I think it's probably more common to maintain separate accounts. But that being said, I do know some couples that do keep separate accounts. I guess I would say this. I don't think there's a right or a wrong answer. For me, the default is you keep a joint account. If you have enough trust in someone to marry them, certainly it makes sense that you'll be able to keep your bank accounts together. And it's just easier to manage rather than trying to juggle multiple accounts. So that's been our approach. Again, could you make separate accounts work? Sure, of course you could. So I think part of it just depends on what's best for you, what works for you, and just discussing it with each other and coming to a decision that you both are comfortable with. I think the more difficult questions come when you have different views of money. And there's a real quick test. If you're thinking about getting married, you want to know if you guys both sort of have the same approach to money. You can look at three things. You can look at either's credit card debt. If one person has a lot of credit card debt and the other one has never had credit card debt and pays off their credit card in full every month, you may have very different views on money. Savings. If someone saved a significant amount of money and the other one has no savings, it's likely you have a very different view on that area of your finances. And then the third one, just check out the car you drive. I know some folks that have no savings, but they get that $30,000 car and have that big monthly payment, and they may enjoy the car, but they're not saving any money. And then I know other folks who pay cash for a $5,000 car so that they can save as much money as possible. Now, again, you're never going to see eye to eye on everything. So the fact that you have differences in the area of money doesn't mean that you're not compatible. It just may mean you have a few things to talk about, perhaps both before and, trust me, after you get married. The conversations of money, they don't go away once you get married. They just get a lot more fun. At least that's my experience after, let's see here, I guess 25 plus years of marriage. So that was Paul's question. That's my view of it. As always, if you have a different view or want to ask a different question, you can leave me a voicemail. Just go to speakpipe.com/DoughRoller. And of course, you can send in an email at dr@DoughRoller.net. So with that, we're going to go ahead and turn to the interview with Larry. I found it very informative. He's been in this business for a very, very long time, and I think you'll find it to be a helpful interview as well. Larry, welcome to the show.
My pleasure.
Hey, I appreciate your time. Today, and something that I've been doing this month is a 31-day money challenge, where I'm writing an article and publishing a podcast every day in the month of January. And a number of the podcasts are focusing on investing. And I thought, who better to help us with that than you? I know you've I guess recently, I think it was last year, published a book called Think, Act, and Invest Like Warren Buffett.
So it came out around Thanksgiving or so of 2012.
Okay. Well, I had an opportunity to read it, and I thought a lot of the things that you said in there would be of benefit to those listening to the podcast. Before we get to
may even be of more interest that it's not what I said per se, because people may or may not value my opinion, but they certainly, I would think, should value Warren Buffett. So the book is filled with his advice.
Right. Well, I'll tell you what, before we get to his advice, can you just share with us a little bit of your background and how you got into the world of investing?
Sure. I spent most of my career helping some of the largest financial institutions in the world, Citicorp and Prudential Home Mortgage in particular, manage all kinds of financial risks. I ran trading rooms, foreign exchange and deposit interest rates, books for both of them. I spent a lot of time also consulting with some of the largest multinational corporations in the world and helping them manage risks like foreign exchange risk, interest rate risk. I've spent time helping them use and actually help create some of the first derivative products that were things like interest rate swaps and collars and ceilings and things. And for the last 20 years, I've been the director of research for the Buckingham Family of Financial Services, which is headquartered in St. Louis. Today, we manage or advise on, directly or indirectly, about $22 billion of assets for individuals, corporate plans like 401ks, and endowments like for museums, schools, etc.
And in your role there, I believe you've written a number of books, not just the one you published last Thanksgiving.
Yeah, I've written now 13 books, including an only guide series. So there's an only guide to stocks, bonds, alternative investments, and the right financial plan. There's 2 books called Wise Investing Made Simple, which are collections of stories that help make the difficult concepts of modern portfolio theory come alive for people by using analogies to cooking, gardening, mythology, sports, etc. I've written a book on behavioral finance called Investment Mistakes Even Smart People Make. There's the Quest for Alpha, which is the evidence on active versus passive strategies. And then, of course, my Warren Buffett book is the latest.
Yeah, and I will, for those listening, I will link to Larry's author page on Amazon so you can check those out. So, Larry, what prompted you to write your latest book?
The book on Buffett came to me because of an incident, which gave me an epiphany. I was in my role as director of research for Buckingham, I'm often called to help keep people from committing what I call portfolio suicide, which is panic and fear sets in, causing people's stomachs to take over the investment decision process whenever we get bear markets like what we had in 2007-8, like what we had after 9/11, like what we had in the summer of 98, like what we had in the summer of 2011 with the European crisis. So people, have this tendency to, even if they have a well thought out plan, they abandon them. And I call it portfolio suicide because it's my view based on my experience. If you sell in a panic, you are doomed to fail forever unless you get extremely lucky, because there's no way that you can ever know when to buy again. There's never that green light, and you're doomed to keep repeating the same mistakes. And I'm happy to share, Rob, there's a very good story about that if you'd like to go into that. But in any case, I was talking with one investor who was about to panic and sell, and the advisor asked me to try to convince him otherwise. And the way my brain works, I'm very much the logic, evidence, less emotional kind of thinker. And so the way I address issues like this is I try to show people the evidence on buy and hold and rebalance versus active strategies, and et cetera. And, so I would cite various studies, and if that didn't convince them, I would cite another study. Well, it became obvious to me that this person wasn't going to be convinced, this time is different, et cetera. And if I wanted to help him, citing yet another study wasn't going to do any good. So I was trying to figure out how I could help him as opposed to try to win the argument, if you will. And that, of course, was my goal. And then I had this epiphany, and I stopped him and said, well, look, let's forget all the evidence. Let's forget my views. Let me just ask you a simple question. Who do you think is the greatest investor of all time? And he said, Warren Buffett. And of course, I know never ask a question you don't know the answer to. I then asked them, well, I know you can't invest like Buffett because you can't buy whole companies. You can't make special deals with Goldman Sachs because you could write a $5 billion check overnight, and you can't get seats on boards. But if Warren Buffett gave you advice, do you think you should listen to it? And he said, sure. And I said, well, let's look at his advice on the issues we're talking about here, like trying to time the market. And I went through what Buffett had said, and that seemed to convince him. And then I tried that with several other people I was having problems with, and it worked almost every time. So I said, gee, why don't I write a book then, to help, if it helped those people, it would help others. And so the first two chapters of that book are basically to teach people how, first, here's what Buffett's advice is. I then try to teach them how to think like Buffett. And the rest of the book is sort of a summary of all of the academic evidence on the right way to invest, how to construct portfolios, how to find an advisor you can trust.
Okay. Well, can you summarize for us then what Warren Buffett tells us, how Warren Buffett tells us we should invest?
Yeah, well, I think the way to do it is to ask three key questions. The first is, should you be an active or a passive investor? And Buffett's answer on that is, he says, you should be a passive investor. In fact, he says to people, if you index, you're virtually guaranteed to outperform the vast majority of investors, both individual and professional. Just by periodically investing in index fund, what he called the know-nothing investor actually outperforms most professionals. So that's the first thing. You want to be passive index-type funds. The second thing he talks about is paying attention to forecasters. Should you do that? That's what a lot of people do. They hear people like Nouriel Roubini or Peter Schiff or whoever the latest guru is predicting gloom and doom, like Meredith Whitney did about municipal bonds. And Buffett's advice is, he says, to ignore all forecasters because they don't know anything about where the market's going, but their forecast itself tells you a lot about them. So that's the second thing. Buffett himself recently said he hasn't even considered a macroeconomic forecast in, I think he said, 25 years. And the third thing he says is regarding this market timing issue. So should you panic and sell, for example, in a bear market, you're timing the market. He says, you should never try to time the market. He hasn't ever done that. His favorite time period is forever. So what I try to teach people, the bottom line is from these things, is that whenever you're about to act on some forecast or someone's opinions, just ask yourself these questions. Has Warren Buffett been acting on this expert's advice? Well, we know he hasn't. And if he hasn't, should you be doing so? Then ask yourself, what do I know that Buffett doesn't know? Well, the answer to that is probably nothing. And then you ask yourself, if I make this change and I'm right, what impact will it have on my life? But what impact will it have if I'm wrong? And most importantly, ask, have I been wrong before? And if you ask them and answer them honestly, that'll lead you to the right answers, which is have a well-thought-out plan, asset allocation, say 60% stocks and 40% bonds, and then simply rebalance and ignore what I call the noise of the market. That's really a short summary of Buffett's advice.
Yeah, and the whole don't time the market, which I think intellectually probably just about everyone listening, well, most people listening to this don't intellectually understand that they shouldn't try to time the market. And I guess you alluded to it earlier in your sense of what you called a portfolio suicide, which in effect is really timing the market. I mean, maybe you're doing so out of fear, as opposed, and sometimes, although sometimes you're perhaps doing it out of greed. But I want to.
Yep, I think both of those emotions happen. And let me tell you that story because I think it's a very valuable lesson for your listeners. So it was Thanksgiving of 2008, and there was a client who I was asked to help prevent him from committing this portfolio suicide. He was absolutely convinced because the world kept collapsing around him. His portfolio was down, I think, at that point, roughly 50%. And people like Nouriel Roubini were saying this was only the beginning. The S&P was going to continue to, collapse. And I pointed out all the evidence. He said, Larry, look, you're going to rebalance me into bankruptcy. That's the term he actually used. And because we were telling him, if anything, what you want to be do is now buying more stocks here to get back to your asset allocation. So let's say he was 60% stocks and 40% bonds, and he was down to, say, 50%. So we're saying you need to buy stocks to get back to your target of 60. And, of course, we had done that maybe once before that year, and, of course, markets had gone lower. So that's why he said you're going to rebalance me into bankruptcy. So I asked him the question, okay, you were about to panic and sell. Can you reach your goal sitting in cash? And he obviously responded, no, he could not do that. So I said, then you have to admit at some point you're going to have to get back into the market. How will you know when it's time to do that? Is there ever a green flag that says it's safe to invest in stocks? And while people may think that's true, like they did maybe in March of 2000 with the NASDAQ at, 5,000 or 5,500, wherever it was, it's never safe. That's just an illusion. So he said, you're right. All right. I said, well, then, since there's never a green flag that will tell you it's safe, how will you decide to get back in? He said, well, let's just do this. Let's wait 30 days to the end of the year, roughly, and if the market's up, then we'll get back in. If it's down, then I haven't caught the falling knife, to use that expression, and we'll wait another 30 days. At least that way I won't rebalance myself into bankruptcy. So I told him, I said, look, that's a plan, but it's a lousy one. Better than no plan, but it's a lousy one, and here's why. The market could turn around just purely randomly in the next 30 days. It'll have gone up, and you missed it. And then it could turn down again after you buy. And if that were to happen, how will you ever be able to buy again? You'll be convinced the day you buy, you're the poor schnook, that it will collapse again. And he said, well, I have to do something. Let's do that. sure enough, and I take no credit, wasn't predicting anything, the market went up roughly 25% in the next 5 weeks. Of course, our clients who had rebalanced and stayed the course made a good amount of money, and now they were rebalancing the other way, right? Selling some stocks to get back to their target. Now, this guy has to come in and he buys. Over the next 9 weeks or so, the market drops almost another 30%. And then he panicked and sold just about the time the market hit its low of 666 for the S&P, and he disappeared. I've never heard from him again. My guess is he could never have gotten back in because he'd be convinced the next time he bought, it would collapse again. And, of course, over the last 4 years, there was never a time that looked safe. We've had all kinds of crises since then, including the European crisis, the Japanese earthquake, which this was going to disrupt world trade, the U.S. losing its AAA credit rating, and all kinds of things. It has never looked safe, and that's the problem. So that example to me is the perfect one about why you should not time the market. You're going to be committing portfolio suicide.
Well, okay. Well, let's get real practical then. We know portfolio suicide. We don't want that. We don't want to follow in the footsteps of your former client, right?
Yep.
But
yes.
Intellectually, that's easy to understand. But when you're looking at a portfolio, your future, your retirement, or your children's education, and it's down 5%, 10%, 20%, 30%, 40%, right? Man, it's hard.
Yep.
It's hard to stay the course. So
yes, it's very difficult.
Right. So do you have any practical suggestions or tips that folks can perhaps use to help stay the course, to help not commit portfolio suicide?
Yeah. Right. So the first thing we want to point out, which is the bad news, is that bear markets happen, and they happen with much greater frequency than people think. On average, stocks go down about 30% of the years, and they go down very big more often than people think. We've now had 3 roughly 50% drops in the market in just the last 40 or so years. 73.4 again in 2000 to 2002, and then 2008. We had roughly those 50% drops. So the odds are good. If your horizon is 30, 40 years now, or maybe longer, you're going to likely have to face those kinds of markets again with some frequency. So you better build that into your plan. The second bit of bad news is, unfortunately, that no matter what the subject is, people are over-optimistic, they're overconfident about their abilities, and it doesn't matter what the question you ask is. So, for example, if you ask people, are you a better-than-average driver, 80 to 90% will answer yes. If you ask them, are they better-than-average lover, the same thing, you'll get that same answer. And if you ask them, are they capable of staying the course with a 50% drop in the markets, far too many people will say yes, they could stay the course, because it's just simply an all-too-human trait called overconfidence. So that's a real problem. The good news is there are ways to deal with this. The first thing is you must know your financial history, like I just told you. So you must be aware that these kinds of drops are not only possible, they're in fact quite likely, and you must build them into your plan. Your plan must then make sure that you do not take more risk than you have, in my terms, the ability, willingness, and need to take. And my book, The Only Guide You'll Ever Need for the Right Financial Plan, helps you design a portfolio by asking you the right kinds of questions to help you figure out what's the right asset allocation. Because I promise you that if you overestimate your ability to take the risk, when the risk shows up, there's a very good chance you will commit portfolio suicide. So you want to make sure you don't lie to yourself. The third thing that you can do is you can hire a professional advisor to help you. He becomes your coach, making sure that, one, you have a well-thought-out plan, you've incorporated these issues, you didn't lie to yourself, and made sure you've thought this through. And when the time comes, and it will come in almost all likelihood, that you will be tested. They will pull out your investment policy statement, which they should have written with you, showing you that you, one, acknowledge that these risks were likely and that you had committed to rebalance, meaning buy when it came up. You also may have committed what I call the development of a plan B that says when these crises come up, here are the steps that I will take to make sure my plan doesn't fail. It might be to cut expenditures. It might be to plan on working longer or sell a second home or buy a car every 10 years instead of every 3 years. That plan B that you can implement to make sure you have a better chance of staying the course and not being alive with no money. So in our own firm, almost every single one of our advisors who are trained professionals have somebody as their personal advisor to make sure that they are staying disciplined as well with their own plan. So that's the advice that I would give you. These topics are well discussed in short order in that Think, Act, and Invest like Buffett.
Yeah. The one thing, you mentioned the first thing about expect a bear market. If you're going to invest for 30 or 40 years, you're going to have years where you're down a lot of money. And I think that is so important because while it's still going to be painful, it shouldn't take investors by surprise. If you're investing
go ahead. Sorry.
Well, it's just that sometimes setting expectations is I think half the battle. If you go in expecting that your portfolio is going to earn 10 or 15% year in and year out, that's unrealistic. And when it doesn't, you're going to panic. But if you know going in that over the next 30, 40, 50 years of investing, you will have years where you're down 20, 30, 40% or more. It's not the whole thing. It's not going to make it a walk in the park, but I think that having that expectation, setting it from the beginning, at least puts you in the right frame of mind to avoid making mistakes that can really, really hurt your future.
Yeah, so I think my way of saying the same thing is, if you think education is expensive, try ignorance. If you're ignorant about these kinds of risks and unprepared for them, you're likely to, one, take too much risk, and then when the risk shows up, you will panic and sell and commit portfolio suicide, and you're unlikely to recover from that. So I think it was Napoleon, who maybe had been the greatest general of all time. He said, battles are not won or lost on the battlefield. They're won or lost in the preparation stage. In this case, in the development of your plan, to make sure that you don't take too much risk, that your asset allocation doesn't have the equity portion exceeding your stomach's ability to take the risk. So we know that markets dropped 50%. That means, if you can't stomach more than, say, a 25% loss, then you probably shouldn't have, at an absolute maximum, more than 50% equities in your portfolio, because that size loss of 25% is likely to happen, and you're more likely to panic and sell. So there is no one right asset allocation, but there is one right for each person based on their unique ability, willingness, and need to take risks.
Yeah, the reference to Napoleon is a good one. Another way I've heard it is, if you sweat in peace so you don't bleed in war. And I think the same applies to investing. So you've, I take it, no doubt, invested for yourself for a number of years. Perhaps maybe when you were just starting out or whatever. I mean, did you make any of these mistakes? Were there investing decisions you look back and think, "Oh, I wish I hadn't done that. That was a bad."
Well, let me
move.
Answer the question this way. I wrote a book called "Investment Mistakes Even Smart People Make and How to Avoid Them." It has 77 mistakes. I probably made most of them in my life because I'm a human being. The difference, I think, between me and many investors is when I make a mistake, just like smart people make mistakes, the difference between smart people and fools is they learn from them and hopefully don't repeat the same mistakes. They may make new ones. I'm sure I'll make other mistakes in my life as well. But once I learn something is a mistake, then repeating the same behavior is what Einstein said is the definition of insanity. Unfortunately, so many investors keep repeating the same mistakes because they're unaware that their behavior is this mistake. And that's why I wrote that book, which contains 77 of these mistakes. So I committed most of them, but I don't commit them, I don't think, any more of them, and certainly in the last 15 years or so, or 20.
Yeah, I remember probably one of the biggest mistakes I made when I started out was I bought a mutual fund that had significant upfront fees, and it was before I really appreciated just how significant fees are to a portfolio's total return. But like you said, I only made that mistake once. I learned the hard way, but at least I learned, I guess. There's that, right?
That makes you a smart person,
yeah, I guess
Rob.
so.
You learn from your experiences and your mistakes.
I would have rather learned from someone else's mistakes, but I'll take what
that's why I wrote my book,
right,
so you
right.
don't have to make those mistakes.
That's right, Larry.
Just read the book and...
We'll learn from your mistakes.
Yeah, exactly.
Right. Okay, well, in your more recent book, Think, Act, and Invest Like Warren Buffett, a couple of things you say. You're very focused on passive index investing. I'm curious, in your view, is there ever a place in a portfolio for individual stocks?
I would say, in general, no. There's just simply no reason to do it. In almost all cases, the reason is simple, that you're taking on far too much what an economist would call idiosyncratic or unique risks that are unique to that company. So the way to think about it is this. You have a small cap stock, whatever it is. It has exactly the same expected return as all small cap stocks in aggregate. And clearly, if you buy all small cap stocks, you're taking much less risk to get the same expected return. The problem is people try to buy the individual stocks because they're way too overconfident that they can avoid the losers, and they're only buying the winners. And the evidence shows they're very poor on average at doing that. The one case where I think you could make a case to buy individual stocks, and even there I'd be very careful about it, is if you have some unique insight to a company that you actually can legally trade on. So, you might be working at a software company, and a friend tells you that, hey, we've developed a product and Apple's going to incorporate it into their, machine. And if that happens, the demand for the product will soar and you could make a lot of money. Well, you better be sure it's legal to trade on it. But if you don't have that type of information, and Martha Stewart found out what can happen if you try to trade on it and it's not legal, then in my opinion, you have no business trying to pick individual stocks unless it's a very small, tiny entertainment account, 1 or 2% of your portfolio. People go to the racetrack and they buy lottery tickets and go to Vegas, but they wouldn't take their retirement accounts there. And my line is you shouldn't take it to the Merrill Lynch office either.
Okay. I confess that I'll just admit this here on air. I have a couple of individual stocks in my portfolio. That being said, I don't disagree with a word you just said, and I won't bog down this interview with why I have a couple of individual stocks. To me, the other aspect of that, though, I will say this: we talk about portfolio suicide. It's hard enough to avoid that when you're investing in a diversified group of mutual funds. But when you start to pick individual stocks, it is really hard to avoid portfolio suicide. I owned Apple when it traded at 700, and when it dropped to 395, and everyone seems to be scared of what, in my opinion, is a company with the best balance sheet in the market. I won't get into all that. But boy, it's hard not to sell. Now, in my case, I'll tell you, I didn't sell, and I bought more at 395 earlier this year. But it's hard. It's really hard not to sell an individual stock when you see its price going down.
Why do you think there are so few Warren Buffett? Buffett tells everybody what his strategy is. Millions of people have tried to replicate his performance, and very, 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 very few succeed because once you, as Buffett says, once you have ordinary intelligence, getting good returns is much more about temperament than intelligence.
Right.
It's really about discipline. If you just bought and held small value stocks, an index of them, for the last 85 years, you got almost 14% a year, far outperforming the market. You did it without a single minute of your time spent analyzing stocks, picking, timing the market. You get to enjoy your life a lot more because you're not wasting time paying attention to people like Nouriel Roubini or Peter Schiff who don't know where the market's going, but they pretend that they do. And you got great returns. I mean, how much better does it get than that?
Right. And you don't have to spend a ton of time researching stocks.
Yeah, none. I don't spend any time anymore. And by the way, I went to school to be a security analyst and portfolio manager. So I used to spend all of my time doing that, and I learned that I was wasting time, not spending it productively.
Right. Okay, well, listen, let me hit you with one last set of questions. In your book, Think, Act, and Invest Like Warren Buffett, you talk about the 5-25 rule of rebalancing. And I read it and I thought it was really good. A helpful sort of, the one thing I liked about it is it's set in concrete. You take your emotion out of things. You just go by the numbers as to when you should rebalance. Can you just describe for everyone what that approach to rebalancing is?
Yeah. Well, first of all, let me point out that having a rule is the key, as you said, because it forces you to act if you stay disciplined. Exactly what the rule is doesn't matter. So there's nothing magical about a 5-25 rule, and I'll explain in a moment. A 4-20 rule or a 6-30 rule may be equally as good. But I try to find a balance here between making sure that your portfolio stays in alignment with the amount of risk you determine was appropriate and having too much cost from trading and realization of capital gains. So the 5-25 rule works like this. With major asset classes like stocks versus bonds, U.S. versus international, what you want to do is make sure that your asset allocation doesn't drift more than an absolute 5% away from its target. So if it's 60% bonds, you don't rebalance unless you get to less than 55% or more than 65%. And the exception to that rule is whenever you have new money, you should always rebalance. Just buy whatever is underweighted in the portfolio because that avoids you having to do two trades. You just do one. You buy the losers or the relative losers, and you don't have to sell winners and pay any capital gains taxes. When you get to the asset classes that are, let's call them sub-asset classes, say emerging markets, and maybe you have 5% in emerging markets, now you don't want to let that go all the way to 0 or 10%. So I set a relative second rule of 25%. So 25% of 5 is 1.25. So now we would let the asset class go down to as little as 3.75 or as high as 6.25 before we would rebalance. So what you do is each asset class, you check whichever rule triggers first, either the 5% absolute or the 25% relative rule, and then you would rebalance when one of those two is triggered. Now, that also gives you a little bit of exposure to what's known as the momentum effect. It allows your portfolio, the winners, to ride a bit and you don't sell too soon. And the losers, if an asset class is doing poorly, tend to continue to do poorly for a while, but you don't buy them right away because you're waiting for the asset allocation to drop significantly. It typically will take, using that rule, maybe a 20 or 25% move in the market to cause you to rebalance. So you're picking up discipline and a bit of exposure to this well-known momentum effect. So whatever rule you want to put in, that's fine with me. Just don't make the bands too tight and create too much trading costs and taxes. Yeah,
and as you said, the thing about rebalancing is it forces you to sell the winners and buy the losers, which seems counterintuitive, right. But like we've been talking about, it's effectively it's effectively buying low and selling high, which is exactly what you want to do.
Right, and that's what Warren Buffett does, right? And that rebalancing forces you to act like your idol, right? Buffett says don't time the market, but if you're going to do so, Buy when there's blood on the street, when everyone else is panicking. Well, that's what rebalancing forces you to do. And he says, sell when others are greedy. Well, it's exactly what rebalancing does, because you're selling what did really well recently.
Right.
But most important, the goal is to control your risk. If you've decided on 60-40, why are you letting the market allow you to be 65% equities or 55%? That doesn't make any sense. Yale's endowment rebalances daily using the cash flows it gets from donations, contributions, interest income, dividends, etc.
Yeah, that's a nice problem to have.
That's the logical thing to do, but they don't have taxes to deal with as we do.
Let me ask you one last question. Do you ever think it's appropriate for someone to be 100% stocks?
I think there are very, very, very few people for whom that's appropriate. One, I think, again, people tend to be overconfident in their abilities. Number two, you really better have an extremely stable job, because you don't want to be forced to sell stocks in a bear market. Say you had a job and you get laid off in 2008 or early 2009, and now you have to sell stocks to put food on the table. It wouldn't have done you any good if you had great discipline and you would have stayed the course otherwise. But if you have to sell because you have to put food on the table, it won't help. So the ingredients would be, one, you better be extremely sure that you could take the risk in your stomach. You better have a very stable job, and you better have an extremely long investment horizon. Those are the three criteria. If you meet them all, good luck.
Right. Okay. Good. Well, listen, Larry, I really appreciate your time today. Thank you so much.
It's my pleasure. Be happy to come back anytime, Rob.
We'll certainly have you back. I appreciate that. Well, I hope you enjoyed the interview with Larry and found it very helpful. As you think about the interview with Carl Richards, if you've listened to it, and the interview with Larry, a big part of the focus is having an asset allocation plan and sticking to it, and not selling when the market crashes, and not running out and buying a bunch of stock mutual funds when the market's going up. It's having a plan and sticking to it. And then the reason this comes up so much with folks like Carl and Larry is it's the hardest thing for investors to do. And so that's why starting tomorrow, we're going to be looking at an asset allocation plan and moving from there over the next several days, at least to show you how I think one ought to be developed and how you can hopefully stick to it over a lifetime of investing. So with that brings our episode to a close. You can find the show notes to this episode. Just go to DoughRoller.net/podcast 24, and I'll leave links to the various resources and books and whatnot that Larry mentioned, and you can find those there. You can leave me a voicemail with a comment or question. Just go to speakpipe.com/DoughRoller. It's really easy to do. You can do it from your computer. Leave me a voicemail. Love to get the messages. You can email me, dr@DoughRoller.net. As you can tell from this episode, I tend to read these email and questions online. I don't ever use your last name, just your first name. But if for some reason you didn't want me to, feel free to put that in the email, and I won't. You can find this podcast at just go to DoughRoller.net/iTunes. That's where this podcast resides. You can leave a review and subscribe. And lastly, sign up for our newsletter, DoughRoller.net/newsletter. So until next time, remember, the best thing money can buy is financial freedom.